Welcome to the Deep Dive. Today we're tackling a company at a truly fascinating crossroads, Novavax, Inc. Now, many of you might recognize the name, but this probably isn't the Novavax you remember from a few years back. This company has undergone a really profound transformation. The big question we're wrestling with, I think, is this. Has Novavax, by shedding its commercial ambitions, embracing this partnership-first model, finally unlocked the true value of its innovative vaccine technology? Or has it merely traded one set of, let's say, existential risks for another? That question really lies at the heart of our deep dive today.
Yeah, what's fascinating here, I think, is that we're examining a company that has fundamentally redefined its path to profitability, and really its very identity in what is a fiercely competitive global vaccine market. So our mission for you today is to extract the most important nuggets of knowledge from our sources. We're talking articles, research, financial reports, basically give you a shortcut to being truly well-informed about NVAX.
Right, we've got a lot to explore, and the stakes, well, they feel pretty high. So let's get right into it. We'll structure this deep dive into two main parts. In part one, we'll lay the foundation. We'll look at Novavax's business, management, and financials. Then in part two, we'll zoom out a bit. We'll examine market sentiment, ownership structure, risks, and finally, our overall conclusion. Part one, the foundation. Chapter one, business analysis. A company in metamorphosis. Okay, so let's begin with this idea of metamorphosis. Novavax is clearly in the middle of a fundamental strategic shift.
Yeah.
What does this deep change truly mean for their business model going forward?
Well, it means they're moving away.
Nah.
Away from trying to do everything themselves.
Right, that old vertically integrated model.
Exactly, where they handled commercialization, sales, distribution, the whole 9 yards. Now they're pivoting to a much leaner, partnership-driven model. Licensing-based.
Yeah, you can see that in the numbers.
Oh, absolutely. The impact on revenue is stark. Look at Q2 2025. Total revenue was $239 million. Of that, $229 million came from licensing, royalties, partnership activities.
Wow, so almost all of it.
Pretty much. Direct product sales were just $11 million. This clearly shows the new model in action. It's not just a slight tweak, it's a complete overhaul.
So they're not building their own global sales force anymore. And a massive piece of this new strategy, kind of the linchpin really, is that big deal with Sanofi, correct?
Precisely. That comprehensive licensing agreement with Sanofi is the absolute central pillar. It offers Novavax potential income streams through significant upfront payments, performance-based milestones, like that $175 million payment they got for Nuvaxovid's full FDA approval back in May 2025.
That was a big one.
Huge. And then there are tiered royalties on sales going forward. And it's not just Sanofi. We also see other collaborations like with Takeda in Japan that brought in $27 million in Q2 revenue.
So it's a portfolio of partnerships, but Sanofi is the main one.
Exactly. It's a calculated act of strategic de-risking, basically leveraging partners' existing infrastructure. And you see that reflected in their expenses too. A substantial 41% year-over-year reduction in combined R&D and SG&A expenses in Q2 2025.
R&D being research and development, SG&A, selling, general, and administrative.
Right. That cost reduction is key to the whole strategy.
That reduction is really telling. Now that we understand how they're operating, what are their key products and services, what unique scientific assets are they actually bringing to the table in this new model?
So Novavax's core value really lies in its scientific platform and a focused vaccine portfolio. Their primary commercial product is still Nuvaxovid, their COVID-19 vaccine.
The non-mRNA one.
That's the one. Protein-based. It appeals to a specific segment of the population. And just recently, August 27th, 2025, the FDA granted full biologics license application approval, a BLA.
BLA, okay.
Yeah, for Nuvaxovid's 2025-2026 formula. It targets the JN.1 variant, specifically for certain high-risk populations. That BLA approval is a critical regulatory milestone. It basically means the vaccine meets the FDA's highest standards for safety and effectiveness.
Got it. But you mentioned the platform. Is there more to it than just the COVID vaccine itself?
Oh, definitely. The true crown jewels, I'd argue, are their technology platforms. There's their recombinant protein nanoparticle technology, and perhaps even more valuable, their proprietary matrix M adjuvant.
Adjuvant, that helps the vaccine work better, right?
Exactly. It's a saponin-based adjuvant that grammatically enhances the immune response. The key benefit and why it's so valuable for licensing out is that it allows for antigen-sparing doses.
Antigen-sparing, meaning you need less vaccine.
Precisely. Think of it as needing less of the actual active vaccine material to get a strong, durable immune response. This can significantly lower production costs and, importantly, allow for much wider global supply capacity, especially in a pandemic situation.
Ah, okay, so the adjuvant itself is a valuable asset.
Hugely valuable. It creates a potentially high-margin revenue stream just through out-licensing it to other companies for their vaccines.
So it's not just about their current COVID vaccine, it's the underlying tech. Beyond COVID, do they have decent pipeline? Future vaccine candidates.
Yes, they do. Their clinical pipeline is strategically focused on major respiratory diseases. The most advanced candidates are a combination influenza COVID vaccine, they call it CIC, and also a standalone seasonal influenza vaccine. Both of those have shown promising phase 3 data.
Phase 3, so quite far along.
Right. Then they also have earlier stage candidates for things like RSV, pandemic influenza like H5N1 and shingles, so definitely not just a single product story anymore.
Okay, interesting. Given this shift in their technology, how do they actually fit into the broader market? What's their market position and the competitive landscape look like?
Well, Novavax is what we'd call a mid-cap biotech firm. Market cap around $1.23 billion as of August 2025. It operates very much as a niche player right now.
Niche how?
Well, take the COVID-19 vaccine market. It's absolutely dominated by the mRNA giants, right? Pfizer, BioNTech, and Moderna. Novavax differentiates itself with its protein-based technology. It offers an alternative.
For people who maybe prefer not to take an mRNA vaccine.
Exactly. Now, the broader biotech market is projected for significant growth, expected to go from about $1 trillion in 2025 to maybe $2.3 trillion by 2032. And the global vaccines market specifically is forecast to expand too, from around $57 billion in 2024 to over $75 billion by 2030. So it's a growing pie.
But a very competitive one.
Undeniably intense. But Novavax's current strategy seems, well, smart. Differentiation through its tech and leverage through partnerships. By partnering with Sanofi, they essentially gain access to a global market without having to build that incredibly expensive and complex commercial infrastructure themselves.
Right, they're in Sanofi's infrastructure, in a way.
That's a good way to put it.
And regulation. We know that's always a huge hurdle in this industry, especially vaccines. How does Novavax navigate that maze?
Absolutely. The vaccine industry is one of the most stringent globally. In the U.S., it's the FDA's CBER Center for Biologics Evaluation and Research that oversees a really rigorous approval process. Gaining that full BLA, like Novavax did with Nuvaxovid, requires extensive clinical trial data. You have to prove safety and efficacy beyond doubt.
And it doesn't stop there, does it?
No, even after approval, there are often post-marketing studies required, PMCs, to keep monitoring real-world performance and safety. The barriers to entry in this whole space are just formidable. You've got astronomically high R&D costs, complex and capital-intensive manufacturing.
The long regulatory timelines.
Exactly. Lengthy regulatory hurdles, the need for strong intellectual property protection, and then managing intricate global distribution logistics. It's a tough business. And Novavax's new partnership model directly acknowledges these huge challenges. They're effectively renting access to partner solutions for these highest barriers, like you said.
So if you were to boil it down, what's their unique selling proposition now? What truly makes them stand out in this crowded, competitive field?
I'd say their core value proposition is really twofold. First, they have a scientifically validated protein-based vaccine platform that serves as a non-mRNA alternative, which definitely appeals to a specific, sometimes underserved segment of the market.
Okay, the alternative technology.
Right. And second, and this is arguably more significant for their future, is that proprietary Matrix M adjuvantant. Its ability to create potent, durable immune responses makes it a highly valuable asset for out-licensing across a whole range of potential vaccines.
So that's where the potential high-margin, capital-light revenue comes in.
That's the idea. And beyond the tech itself, you can't discount their accumulated institutional knowledge in vaccine development.
Yeah.
They've been at this for decades. That's a significant intangible asset.
Okay, that makes sense. A lot hinges on that Matrix M, it sounds like. If you're finding this deep dive valuable, remember to like and subscribe to Stock Analytics AI on YouTube. Members at $4.99 a month get priority deep dives on tickers, and we'll be covering all of the S&P 500 stocks over the next few months. If you want a one-off deep dive on a specific company, just drop us a super thanks. Chapter 2. Management Evaluation. Stewards of a Strategic Pivot. Now, let's turn our attention to the leadership team, the ones steering this dramatic strategic pivot we've been discussing. You mentioned this metamorphosis, aggressive cost cutting. What does this tell us about the current management team?
Well, the current team, led by CDO John C. Jacobs, he came on board in January 2023. They Basically inherited a company in a significant crisis, real financial pressure.
Right. Things look pretty bleak for a while there.
They did. His response was swift and pretty decisive. A complete pivot to this partnership model, really aggressive cost cutting, including, I think, a 30% workforce reduction since the first quarter of 2023, and a renewed focus on financial discipline.
So tightening the belt significantly.
Absolutely. Key achievements under his leadership so far include securing that pivotal Sanofi licensing deal, obviously, and successfully guiding Nuvaxovid to that full FDA BLA approval, which, as we said, triggered that crucial $175 million milestone payment.
His background seems relevant.
Yeah, Jacobs' background includes time at Harmony Biosciences, Teva, and Pfizer. It aligns pretty well with this strategic direction, emphasizing commercial execution through partnerships rather than building out direct sales forces. The challenge for them now really shifts from just survival to consistent execution, managing these complex partnerships effectively, making smart capital allocation decisions. That's the focus now.
Given such a dramatic pivot, how have they been with transparency, communicating this fundamental change to investors?
They seem to maintain pretty transparent communication through their investor relations website, SEC filings, regular quarterly earnings calls. They've been quite clear, I think, in articulating this strategic shift and what it means, offering insights into the new direction. Our research didn't really uncover any significant ethical or reputational concerns during this transition period.
Okay. You mentioned capital allocation earlier. How do their spending decisions directly reflect this new, lean, partnership-focused strategy?
Capital allocation seems very disciplined now. The focus is clearly on advancing their core R&D pipeline, particularly the CIC, that's the combo COVID influenza vaccine, and the standalone influenza vaccine, plus exploring the broader potential of Matrix-M.
And how they approach R&D spending has changed.
Yes, their R&D approach is explicitly described as capital efficient. What that means is they aim to make smart, lower-cost bets to get assets to proof-of-concept stage, and then secure partners for the really expensive late-stage clinical trials.
So they're not funding phase 3 trials themselves if they can help it.
That seems to be the strategy. You won't see them pursuing large M&A deals, acquisitions. Instead, they're focused on out-licensing their own technology and assets. It's also important to note the company has no history of share buybacks or dividends.
Which is pretty typical for biotech in this phase, right?
Pretty typical for a biotech prioritizing R&D for future growth. So shareholder returns are entirely dependent on the stock price going up, capital appreciation, rather than any cash payouts.
Okay. This raises an important question, especially for a company in transition like this. What about their return on invested capital? ROIC, investors often look at that.
Yeah, you're right to ask. Novavax's ROIC has been extremely volatile and mostly negative historically. Now, their trailing 12 months TTM ROIC looks great at 36.62%, but, and this is a big but.
There's always a but.
Always. This is really a statistical anomaly. It's a direct result of that non-recurring $175 million Sanofi milestone payment. It contrasts sharply with the prior year's negative 63.99%.
So that positive number doesn't really tell the whole story of underlying efficiency.
Not at all. It actually kind of obscures their underlying operational efficiency. It reminds us why single-period financial metrics can be so misleading for companies undergoing big changes. The real insight isn't the number itself, but how this one-time event makes traditional valuation tools almost irrelevant right now. You have to look at the qualitative pivot and future prospects.
So we need to see a more normalized ROIC over time.
Exactly. A normalized recurring ROIC is needed to assess long-term viability. However, that positive figure does at least signal the potential profitability of their new, leaner model if it works out.
Chapter 3, Financial Analysis. Deconstructing the bottom line. Okay, let's dive into the core numbers now. Let's deconstruct Novavax's bottom line. How do the financials really stack up?
All right. As of August 2025, Novavax has a market capitalization of about $1.23 billion. That puts it firmly in the small to mid-cap biotech segment. Just for perspective, that's far smaller than giants like Pfizer, around $140 billion, or AstraZeneca at $248 billion. They're playing in a different league, size-wise.
And revenue. You mentioned volatility before.
Extreme volatility. Looking back 5 years, they had just $19 million in revenue in 2019. Then it surged, peaked at nearly $2 billion in 2022, mostly from the COVID vaccine sales during the pandemic height.
Right.
Then it declined sharply to $682 million in 2024. Now, the full year 2025 adjusted revenue forecast is between $1.0 billion and $1.05 billion. So a rebound.
But mostly from Sanofi.
Almost entirely. It's crucial to understand this rebound is almost entirely attributable to the new Sanofi partnership income, not a return to strong organic product sales from their own commercial efforts.
Got it. So that revenue is certainly swinging wildly. What about profit margins? Are they actually making money under this new structure?
Margins have also been highly erratic, as you'd expect. The recent TTM figures look dramatically positive on the surface.
Wow.
Gross profit margin, 57.18%. EBIT margin, that's earnings before interest and taxes, 33.96%. Net income margin, 39.28%.
It's good on paper.
Yeah, but just like the ROIC, these are largely artifacts. Artifacts of that big Sanofi payment and the aggressive cost-cutting. They are not yet indicative of sustainable, recurring operational profitability. Prior years consistently showed deeply negative EBIT margins.
So again, potential signal, but not proof yet.
Exactly. While these current positive figures aren't sustainable at these exact levels, they do signal the potential for profitability under the new, leaner model if it performs consistently over time.
When we look at the company's financial history, say in a 5-year financial summary, what really stands out in terms of revenue, profit, and cash flow trends?
What jumps out immediately is the sheer scale of that revenue spike in 2022, nearly $2 billion. That's huge for a company this size. But crucially, even with that record revenue, net income was still a loss of $658 million.
Still losing money despite billions in sales.
Yes, and operating cash flow was negative $415.9 million. This paints a really vivid picture of significant cash burn.
Meaning spending way more cash than they generated from operations.
Yeah. Right, even at their revenue peak. A persistent history of significant negative free cash flow, that cash burn, has been a defining characteristic of Novavax for a long time. Yeah. Operating cash flow was negative $714 million in 2023 and remained negative $631 million over the last 12 months. Their free cash flow to revenue ratio, TTM, is a deeply negative 61%. Ouch. Yeah. Achieving sustainable positive free cash flow is arguably the most critical hurdle for Novavax. The entire strategic pivot is designed to fix this fundamental issue. Earnings consistency, also poor. Losses have been the norm for the past decade, just briefly interrupted by these non-recurring events. The current TTM EPS, earnings per share, of $2.63, definitely an anomaly driven by that profitable Q2 2025 from the Sanofi payment.
Okay, so cash flow is the big thing to watch. How about their financial stability going forward? Debt levels, liquidity, can they weather a potential storm?
Well, their debt-to-equity ratio is exceptionally high, 453.3%. That looks scary.
Very high.
However, there are some mitigating factors. They do have $612.3 million in cash and short-term investments on hand. That cash position significantly exceeds their total debt.
Okay, so they have cash to cover the debt.
For now, yes. Their interest coverage ratio is also strong at 15.5 times EBIT, meaning they can comfortably cover their interest payments. And importantly, they recently completed a debt refinancing, pushing out maturities to 2031. That buys them crucial time.
So they have runway. What about short-term obligations?
For short-term liquidity, Novavax actually looks quite strong. They have a current ratio of 2.36. That means their current assets, like cash and receivables, at $919.5 million, comfortably cover their current liabilities of $389.1 million.
So low risk of near-term insolvency.
Correct. Indicates a low risk there. And again, as we noted before, they do not pay a dividend. All cash is focused internally.
Okay, if we connect all this back to the bigger picture, how on earth do you actually value a company like this? With such volatile financials, a huge strategic pivot, traditional metrics must be really tricky.
Valuation is incredibly tricky here. You're right. The TTM price-to-earnings PE ratio appears deceptively low at 2.85.
Which normally signals cheap.
Right, but this figure is highly misleading precisely because of that one-off Sanofi payment-boosting earnings. Look at the forward PE based on analyst expectations. It's sharply negative at negative 29.54.
Indicating analysts expect losses again.
Exactly. Trying to directly compare them to peers using PE is also challenging when many tiers also have negative earnings. The metrics just break down. For example, our comparison table shows Novavax with that TTM PE of 2.9, but larger competitors like Moderna and BioNTech are also currently showing losses, so a direct comparison doesn't tell you much.
So PE is not very helpful here. What else?
A discounted cash flow, or DCF analysis, is probably more fundamental in this situation. It tries to estimate intrinsic value by forecasting future cash flows and discounting them back to their present value.
But forecasting those cash flows must be tough.
Extremely tough. Given the incredibly high uncertainty surrounding Novavax's future, well, An educational DCF model yields a very wide intrinsic value range. We're knocking $6 to $15 per share.
That's a huge range.
It is, and it reflects the truly binary nature of their potential outcomes, success or failure of this pivot. The key DCF assumptions are highly sensitive. You need a granular, event-driven approach for near-term growth rates, probability adjusting for potential milestone payments. Midterm growth would hopefully come from royalties, maybe the CIC vaccine launch. Long-term, you have to be conservative, maybe 2-3%. And crucially, you need a high discount rate, or WACC, weighted average cost of capital. Maybe 12% to 15% is necessary here.
That is so high.
Because of the significant risk involved, their heavy dependency on partners, the inherent clinical trial risks, intense competition, and that demonstrated revenue volatility, you have to account for that higher risk.
Part 2. The broader picture and future. Chapter 4. Market sentiment. Okay, we've dug into the business, management, financials. Now let's look at what the market is thinking. How is Wall Street perceiving Novavax right now, especially after these big strategic changes?
Well, the analyst community, for starters, is really deeply divided. The consensus rating is hold, which basically signals a lack of strong conviction. Either way, they're waiting and seeing.
No strong buy or sell signal.
Pretty much. And the price targets reflect that division. They range dramatically from as low as $6 all the way up to $25 per share.
Wow, that shows fundamental disagreement.
Absolutely. But what's interesting is the average analyst target. It hovers around $12.86 to $13.14. Now, compared to the current share price of about $7.58, that average target actually implies a potential upside of over 70%.
So on average, analysts think there's significant upside from here.
It suggests that at least some analysts, perhaps the majority weighting the average, believe the market might be underestimating the long-term potential of the Sanofi partnership and the pivot.
Has recent news shifted these perceptions at all? I imagine the BLA approval and those Q2 earnings must have made some waves.
They definitely did. The tone of recent news has been predominantly positive. Media coverage focused heavily on that surprising Q2 2025 profitability, the full FDA approval of Nuvaxovid, and also the encouraging clinical data coming out for their pipeline candidates.
And the stock reaction.
The stock jumped. It surged over 18% in pre-market trading right after those Q2 earnings were announced. That indicates genuine surprise, maybe a potential shift, albeit maybe still fragile, in investor perception.
Okay, what stands out to you about other market indicators, beyond just analyst ratings and news flow?
One of the most telling indicators for Novavax right now is the exceptionally high short interest.
Short interest, people betting the stock price will go down.
Exactly. Currently, 38.07 million shares are sold short. That represents a substantial 29.64% of the public float the shares available for trading.
That sounds really high.
It is significantly higher than most peers. It signals deep market skepticism. Essentially, a large financial bet against the company's long-term success. However, there's another side to that coin.
The short squeeze potential.
Right. For those who are bullish, this high short interest also creates the technical conditions for a potential short squeeze. If positive surprises keep happening, those short sellers might be forced to buy back shares to cover their positions, which can rapidly drive the price up further.
So it adds another layer of volatility.
Definitely. Technically speaking, the stock's current price, around $7.58, is trading just above its 50-day moving average of $7.37. That usually indicates some positive short to medium term momentum.
Okay.
But it's just slightly below its 200-day moving average of $7.65. That's often seen as a critical long-term inflection point.
So technically it's kind of on the fence.
Pretty much. Neither the bulls nor the bears are in firm control of the long-term trend just yet based on those averages. It really looks like a battleground right now.
Chapter 5. Ownership structure. All right. Beyond just what the market's saying day to day, who actually owns a piece of this company, this transforming company? What does the ownership structure tell us about the conviction, or maybe lack thereof, among the big money investors?
Well, institutional ownership is quite substantial. It accounts for over 50% of the outstanding shares. This includes major passive index funds, like the Vanguard Group and BlackRock, standard stuff. But it also includes more active players like Shaw Capital Management, Co2 Management, and interestingly, Sanofi itself, their key partner.
Sanofi owns shares too. How much?
Yeah, Sanofi holds over 4% of Novavax's outstanding shares, according to recent filings.
That's significant, more than just a partner.
It signals a vested interest beyond just the licensing agreement, definitely. Although overall, recent filings show pretty mixed institutional activity, some buying, some selling, which kind of mirrors those divided analyst opinions we just talked about.
Okay, so Big institutions are involved, including their main partner. But what about insider ownership? The management team, the board, do they have much skin in the game?
That's where the picture looks quite different. Insider ownership is remarkably low, less than 1%.
Less than 1%.
Yeah. And an analysis of insider transactions over the past 12 months reveals a pretty clear pattern of net selling. There were 13 sales transactions totaling over 210,000 shares versus only 4 purchases totaling just over 5,000 shares.
Mostly selling, very little buying.
Right. And notably, there have been no open market purchases by insiders at all in the most recent 3-month period. This lack of significant skin in the game from the leadership team.
Well, it stands in stark contrast to the bullish strategic narrative they're presenting. It's something investors often raise an eyebrow at.
Yeah, you like to see management buying if they're optimistic.
Generally, yes. It's also worth noting that ownership is highly concentrated here. The top 10 largest shareholders collectively own over 50% of the company.
So a few big players have a lot of influence. Exactly. It means a relatively small number of large institutional investors can exert considerable influence over strategy, governance. And importantly, their trading decisions, if a big fund decides to sell, can disproportionately impact the stock price, adding another layer of potential volatility.
Chapter 6, Risk Assessment. Okay, every investment carries risk, and a company undergoing this kind of radical transformation, like Novavax. Well, as we posed at the outset, it's certainly no exception. Let's break down their strengths, weaknesses, opportunities, and threats. A classic SWOT analysis. How does that look?
Yeah, if we connect this back to our opening question about trading one set of risks for another, the SWOT analysis is pretty revealing. Strengths. They definitely have proprietary differentiated technology, that nanoparticle platform, plus the Matrix M adjuvant. It's scientifically validated. They also have regulatory validation now with that full FDA BLA for Nuvaxovid. Their aggressive cost-cutting has led to a much leaner, more agile operating structure. And, of course, that cornerstone Sanofi strategic partnership provides critical market access and revenue streams.
Okay, those are the pluses. What about weaknesses?
Weaknesses.
Yeah.
There's profound revenue concentration and just dependency on that single major partner, Sanofi. That's a big one. They also carry that long history of cash burn we discussed. They've dismantled their own commercial infrastructure, which could be a weakness if they ever wanted it back. And there's that history of inconsistent profitability.
Makes sense. Opportunities or upside potential.
Opportunities, significant pipeline monetization potential, especially with that high-value COVID-influenza combination vaccine they're developing with Sanofi. Further licensing of the Matrix M adjuvant for other diseases beyond respiratory presents a really high-margin opportunity. They could also expand their own vaccine portfolio further. Our RSV, pandemic flu, shingles candidates are there, and capture a durable niche market for people who prefer non-mRNA vaccines.
And the flip side, threats.
Threats. Intense competition from the mRNA giants isn't going away. They face perpetual clinical and regulatory hurdles. For every new candidate failure is always a risk. There are shifting market dynamics, particularly as the intense global focus on COVID-19 continues to wane, and, crucially, significant partner risk. What happens if Sanofi's strategic priorities change? Or their leadership changes? That extreme dependency on Sanofi directly speaks to that idea of trading one set of risks for another.
Right. They solved one problem but created a dependency. And what about broader economic or even geopolitical factors? Can those external forces really impact a biotech company like Novavax?
Oh, this raises an important point. They absolutely can. The current macroeconomic environment, for instance, with elevated interest rates, that poses a direct threat.
How so?
Well, higher rates increase the cost of any future financing Novavax might need if they burn through cash again. It also raises the discount rate, the WACC, used in valuation models, which inherently puts downward pressure on the stock's estimated value. Persistent inflation could also increase their remaining R&D and clinical trial costs.
Okay, so macro matters. What about geopolitics? Trade issues?
Yes, that's relevant too. For instance, the implementation of new U.S. tariffs in 2025. There's a planned 10% levy on most global imports and potentially much higher tariffs, up to 245% on things like active pharmaceutical ingredients, APIs, coming from China.
How does that affect Novavax if they're not manufacturing much themselves?
It's an indirect threat, but still significant. While Novavax has reduced its own manufacturing footprint, its partners, including Sanofi, operate complex global supply chains. These tariffs could increase their partners' cost of goods. That could potentially reduce the royalty payments that flow back to Novavax.
Ah, it's their revenue indirectly.
Exactly. Or it could cause supply chain disruptions, delaying critical milestones, and the associated cash payments Novavax is counting on. It just introduces a whole new layer of external risk that's largely outside Novavax management's direct control.
Chapter 7. Conclusion. So after this really deep dive into Novavax's dramatic transformation, where do we stand on that central question we started with? Have they truly unlocked value with this pivot? Or have they simply traded one set of existential risks for another, maybe even riskier set? Let's summarize the key arguments, the bull versus bear case.
Okay, the bull case. It hinges entirely on the successful execution of this strategic pivot. Management has, in the bull's view, successfully de-risked the business by offloading those costly, complex commercialization efforts to a global giant like Sanofi. They're aiming for sustainable profitability maybe as early as 2027. The core belief here is that the proprietary Matrix M adjuvant holds significant sort of latent value that's ready to be unlocked through high-margin licensing deals across multiple diseases.
So the tech is the key.
The tech and the execution of the partnership model. If they execute this well, proponents argue, the stock could be significantly undervalued right now. The market might be underappreciating its long-term earnings power as a lean, IP-focused company.
Okay, that's the optimistic view. What are the other side of the coin? The bear case for Novavax.
The bear case remains highly skeptical. They tend to view the recent profitability as, well, somewhat of an illusion, just an accounting artifact of a one-time payment rather than proof of sustained operational efficiency.
Not real, recurring profit.
Right. This new strategy, the bears argue, has merely swapped the risk of commercial failure for an extreme dependency on Sanofi's strategic whims. It puts Novavax's fate largely in its partners' hands. The company's persistent history of cash burn, combined with that notable lack of insider buying, suggests to bears a likely return to unprofitability once these big milestone payments are exhausted. And that exceptionally high short interest. Bears see that as a quantitative vote of no confidence, a bet that any significant delay or failure in the partnered pipeline could trigger a fresh financial crisis for Novavax.
So very different views on the same set of facts. What's our overall intrinsic value range, again, reflecting these almost binary outcomes?
Reflecting these highly uncertain and, almost binary outcomes, the success or failure of this whole pivot, our educational discounted cash flow, DCF, model suggests that wide valuation range, again, $6 to $15 per share.
Okay. And at its current share price, around $7.58, where does that sit?
It trades near the lower end of that fairly wide range.
So the market is pricing in a lot of the risk.
It suggests exactly that. It suggests investors are indeed factoring in a high probability of future challenges. They seem deeply skeptical about the company's ability to consistently achieve the more optimistic scenarios embedded in the higher end of that value range.
So it really boils down to...
It's truly a high-risk, high-reward proposition right now. The entire investment thesis hinges completely on whether Novavax can successfully transition from being a cash-burning R&D outfit to becoming a lean, cash-generating intellectual property licensor through these partnerships. That's the whole game.
What stands out to you, our listeners, about Novavax's transformation? Do you think they've finally found their footing with this new model, or are they simply dancing on an even tighter rope now? We definitely encourage you to dig deeper into the sources, the financials, and form your own conclusions. And if you found this deep dive valuable, please remember to like this video and subscribe to Stock Analytics AI on YouTube. Members, for just €4.99 a month, get priority requests for deep dives on tickers. We're planning to cover all of the S&P 500 stocks for the next few months, and members get that exclusive priority access. If you just want a one-off deep dive on a stock you're interested in, drop us a super thanks.
And just a reminder, as always, this analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
That's all for this deep dive. Until next time, keep learning, keep questioning, and keep exploring.